overall, if you look at, there are two broad themes, right? One is absolutely industry-leading performance, revenue growth, quarterly numbers we executed very well. We met our guided range, largely in the upper end of the guided range. Very, very good execution, delivering an EBIT, which is again in the higher end of the guided range, in spite of some headwinds due to the strengthening rupee. So I think overall, quarter and fiscal, I'm very happy. I mean, great job by all HCLites to deliver industry-leading performance. And it's not just industry-leading. I mean, we are significantly ahead of everybody else. And the second theme is, I mean, while we are continuing to look at our overall growth and how are we doing, I think the most important element which will really drive the long-term viability and evolution of us as a business is how are we doing in our Mode 2 and Mode 3 offering, which is what I call as the next generation services, and how are we evolving quickly into the next generation technology services form. We have four key offerings in our Mode 2 services: digital and analytics, where we brought in a number of disparate capabilities across HCL, starting from platform engineering, our infrastructure services, our application services, analytics, all of them, and really created a practice called DNA, which is digital and analytics. And then second element is IoT Works, which is really, there is a pervasiveness of connected devices, and the devices are exploding. How can we really leverage the power of connected devices, connected assets, and the connected user? That's really the IoT Works, cloud native and security. And of course, products and platform is really a great future growth trajectory for us. So I think our success in the Mode 2 and Mode 3, which grew 30.9% year on year, I think that's really the secret. I mean, the real driver of our performance lies in Mode 2 and Mode 3.
Right. Anil, before I come to just a couple of follow-up questions on the quarter that was. Though it's much higher than peers, it's still a little lower than at least what we were estimating. We were factoring in 4.98% kind of sequential growth. You've come in at 4.1%. Is this because of IMS, which I think was 0.9% this quarter, perhaps lower than expected, or lesser contribution from acquisitions, because that also was expected to contribute at least 3% to the growth number. So tell us what didn't work as far as Q4 was.
See, I think when we met everyone in the last quarter, we said we will be in the middle of the guided range, from the 12 to 14% guided range, and then acquisitions will contribute a little bit more. Geometric was the only variable. I think we had just 1 month of Geometric revenue, so the inorganic contribution was a little lesser than what we expected. Otherwise, we're pretty much on the dot. In fact, from our committed performance, we are on the last decimal. We're pretty much on the dot.
Right, and talking about your guidance for the next fiscal, 10.5 to 12.5%, which again is much higher than what your peers are talking about. What percentage of this will come from acquisition?
I think whenever we did an acquisition, I think as a practice we announce how much potential revenues will come in a full year. But after we integrate an acquisition, it's pretty much difficult to track in a meaningful manner. So you have the numbers. I mean, there are 4 or 5
Would it be fair to say 3% or?
Yeah, I mean, it's. I think your ballpark, I would say you're right.
Okay.
Maybe a little bit more, but that's very
4%.
I don't want to call it, because it's not that I don't want to share. It's very difficult, right? Because when you acquire an entity, you continue to do synergy, upsell, cross-sell, all of that. You may also rationalize some portfolio. You may drop some revenue base. Because at the end of the day, we need to make the acquisition work and get the margins to our standard levels. Right? So there are many dynamics which plays into it. So after acquisition, we don't track it exactly by the acquisition. It's very difficult as well, because we sell a lot of other services into same clients. Some of the services that we've acquired goes into our other larger customer base. So.
Anil, the big positive is, of course, that you've maintained your operating margin guidance, 19.5 to 20.5%. You have done this. Have you factored in, salary hikes, also increasing investment in the US? Because in the commentary you have spoken about investment in high growth areas. So how are you going to accommodate margins despite all these investments? What kind of levers are you going to really push going forward?
Sure. So if you look at the last year, we gave a guidance of 19.5 to 20.5, and we came at the upper end of the guidance, which is 20.3.
20.3.
This is 20 basis higher than what we had achieved in the financial year 16. And this is in spite of having sort of acquired lot of pieces and integrating
in spite of integration.
Integration of them. This year, if you see our guidance, we have kept 19.5 to 20.5. Last year, the exchange rate dollar rupee was 67 average. This year, for this guidance, we have taken 65 rupees and 50 paise. So in effect, I have upped my guidance.
Okay.
So. So I think there's a lot of confidence in terms of, as Vijay explained, in terms of our strategy, which is the Mode 2, Mode 3 strategy. With the newer service offerings to our customers, and making sure that we are relevant and we sort of get more pie of the customers' budgets and help our customers achieve the more, either at the front end in terms of digitalization or at the back end in order to reduce and address costs.
Right. Give us a sense of, what kind of investments will be needed. In the last few weeks, we've heard companies, giving numbers on how much they will hire in the US in terms of delivery centers. Is that something that you will be doing as well? Give us some numbers on whether local hiring is going to be a big focus for you.
So local hiring has been a focus for us for many years now. So if you look at our profile, we have 12 delivery centers in the US. We have 12,000 people in the US, and more than half of them are locals. They are not visa dependent. So we have already created that ecosystem, which sort of helps us to.
Already,
yeah, that's correct. We already created that ecosystem over many years, which helps us.
The whole investment started about 7-8 years back. So I personally don't see any investments in delivery centers because we're really ahead of the curve. And maybe a lot of other players are talking about building centers now, which we did 7 years back. Some of our businesses demanded, and we consciously wanted to make our business model, make our delivery more resilient and not
less
really
visa dependent.
less visa dependent, because this is not a new thing, right? Every time there has been a conversation around immigration, maybe now people are reacting to it, but we have structurally kind of focused on it, created a lot of onshore presence, and that's really helping us. So there's nothing new that we need to do. We just need to continue our strategy of more local hiring, and there's no new investments in delivery centers planned.
Right. In terms of performance appraisal, again, some news flow about layoffs, especially at the senior levels, mid levels. A lot of people talking about how the employee pyramid needs to be corrected. What's the case with HCL Tech? Do you see similar pressures at the mid management level?
See, today my pressure is to hire more, because when we are growing at 14% on a constant currency, absolutely there is a lot of demand and talent requirements, and we are continuing to look at hiring as well as significant investments going into retraining our people, right? Because all our growth in Mode 2 and Mode 3 services have to be delivered by upskilling and making the existing talent pool more relevant. I think that's where we are focusing, and I think we are continuing to be much more bullish. It's a little bit contra to what the industry view is, but I think it's really a validation of our real strategy working at certain scale.
Right. CVK, you've been instrumental in sort of, driving the IMS business. Even in the last fiscal, it's grown in double digits, except for maybe Q4. Is that sustainable going forward? The advent of cloud obviously is creating both opportunity and threat. You also have, infrastructure as a service causing disruptions. So where do you see IMS in the coming year? Is this kind of high double-digit growth sustainable?
So one is, we are very happy. We had a spectacular growth in IMS last year, 27% year on year. Moving forward, having seen this business and having seen the application business as well over the last 15 years, I think there is a blurring lines between application and infrastructure services. If you look at cloud native adoption, cloud migration, it's a lot about modernizing existing applications and refactoring and rewiring them for the cloud. And our capability in infrastructure and our capability in applications helps us drive that strategy around cloudification, strategy around digital adoption.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.